So I'll start off this video with this particularly interesting description about Google from Jeff Bezos personally. Treat Google like a mountain. You can climb the mountain, but you can never move it. It's arguably one of the best company on the planet, if I can actually say so. But why am I still not invested? Short answer, because it doesn't fit into my nickname of falling knife cheeking. Jokes aside, because of the resiliency of the business and how entrenched the different products and services it is in our everyday lives, the valuation of Alphabet, which is Google's parent company, has remained largely intact even though some other companies out there have fell beyond recognition. Looking at you, Facebook and Mark Zuckerberg. So I'm also currently looking at the like button, waiting for you to smash on it, so don't let it get away. Oh, and one more thing. Not sponsored by the way, but I know many of you out there probably have not maxed out all the available sign-up rewards. Currently, stockbrokers like Tiger, Moomoo, and even Weibo have extremely aggressive sign-up campaigns that gives you essentially risk-free return. Where can you get something like that? Moomoo and Tiger Brokers is giving out cash coupons and even free shares, and if you're lucky, you can get a free Tesla stock. While Weibo on the other hand is giving out $100 worth of Apple shares, and you shouldn't allow all these 100% ROI deals get away. I'll leave the link to all these brokerages in the description box down below. Now, I'm not going to feed you more confirmation bias on how good the underlying business model is. Everyone knows how good Google is. It runs a monopoly on search, its advertising business operates in an oligopoly structure with Amazon and Facebook, and despite the increasing market share of Amazon, Google and Facebook seems to have already concretized their position based on the past trends and even future projections by many of all those consulting groups. And they have one of the most pristine balance sheet on planet Earth. That being said, however, other than picking good businesses, being the cheapskate I too am concerned about the valuation I'm currently paying for, which will be elaborated a little bit further in the video. First, we will take a look at a few qualitative factors before we start crunching the different numbers. Currently, it's a market-wide phenomenon where we are experiencing two levels of compression. So the first layer or the first level of compression is a valuation compression, and the second layer is a potential earnings compression. So judging from how the S&P 500 and even Nasdaq has performed year to date, the first layer of valuation compression is already underway. Now, I would play a very quick snippet from the All In pod some time back where Chamath was essentially describing the shrinking effectiveness of online advertising from a macro perspective.
The shrinking effectiveness of online advertising. And I think that's why you then saw 2 days later, Facebook got taken to the woodshed in 2 days, was down, now it's down, 15, 20%. Google, I think, has been down a lot. Today it's just getting absolutely smoked relative to the market. So that's the macro issue, which is, I think, it's really hard for these ads to be as effective as they used to be. And it's only going to get worse because Google has also said that they're going to implement a lot of the same versions of what Apple did inside of Android. So customer acquisition is going up. So if you look at then all the companies that have to live and die on CAC, it's going to be an expensive road. That's the macro thing, I think, that not enough people are talking about.
Now, every mother-son is essentially calling for a recession. And we know that the R word is pretty much a bad thing. People lose their jobs, purchasing power decreases, people spend lesser, companies stop hiring, more people lose their jobs, and it traps itself into this entire negative reinforcement cycle. So I've briefly talked about this major concern in my Meta Platforms video as well. At current valuations, based on the trailing 12 months figure that the company reported, both Facebook and Google are at an attractive valuation. 12 times PE for Meta, 20 times PE for Alphabet. So the worry that many smarter investors out there have is just purely on the basis that the underwriting of all these said projected earnings are mostly, or if not all, inaccurate. So if we were to just observe the free cash flow growth of Alphabet over the last decade, it's on an exponential curve. And this recent jump from 2020 to 2021 looks insane, if I can put it. 42 billion to 67 billion, a 56% jump. Not forgetting that in the previous 2 years, they grew free cash flow by 35 and 38% year on year respectively. And that, my friends, is the power of a tech conglomerate. That being said, I'm not trying to spoil the party or anything. Given the current headwinds on the world stage, it does feel a little ridiculous to continue projecting all-time highs after all-time highs, like how Chamath put it, for 2022 and even moving into 2023, where the situation in the real world continues to worsen. So after Meta's lead into the forays of freezing hiring, Alphabet essentially followed suit and started restructuring and even laying off Google Cloud support staff. Clearly, this is foreshadowing something ominous. Some of you would immediately bounce back at me, saying that, hey, what do you mean? On one hand, you are extremely bullish on Meta, which is arguably a quote-unquote dying company. But you have such little trust and faith in Google, which is arguably one of the best companies on earth. Are you okay? Calm down, bro. I understand why some of you have such skepticism. So to just get things straight for the record, I'm overall still extremely bullish in the long term about the entire digital advertising space. And due to the nature of the industry as a whole, I think they have fairly entrenched themselves. Furthermore, it's exactly because of the said headwinds that many market participants are already aware of. Hence, the two companies are trading where it is today. If not, I think they could easily fetch 25 or even 30 PE for Google's case. So it's essentially the market, quote-unquote, attempting to price in the risk that is involved. So my only worry, like I highlighted previously, if every investor is expecting Meta's bottom line to be adversely affected, both via spending and top line reduction, if we were to invest in another company in the same industry, we would have to then ascertain which has a greater impact and by how much. So simply put, for Meta today, many investors seem to already just draw a doomsday scenario for the company. And that's it. Similarly, some might even go as far as saying that even at current valuations, Meta platforms might be a little bit too expensive. Look, if Meta has a PE of 12 today, assuming that they halve their earnings, 24 PE is still extremely expensive for a dying company. That I can agree. The thing that I find it hard to comprehend is the story that the same investors, expecting Meta to halve their earnings, also expects Google to continue growing both top and bottom line by minimally 10 to 15%. If that's really the case, that's a delta or a difference of more than 60%, despite having very similar business drivers. I do, however, also agree that theoretically, investors should pay a premium for a superior business. Like Munger puts it, buying a great business at a fair price rather than being obsessed with buying a fair business at a great price. Personally though, I think that both Meta and Google are great businesses. Although I will concede to the fact that, hey, one is greater than the other. However, I would be excited to jump into Alphabet when it hits my own required rate of return based on my own valuation. So I did a simple DCF based on a few general assumptions. Currently, I don't think that they will be able to hold their current monstrous free cash flow, but can easily recover 2 years out and essentially still grow at a healthy 50% clip. Generally speaking, Alphabet trades at a price to free cash flow multiple of at least 30 to 40. So I dragged down the long-term multiple to only 25 in the name of trying to be conservative. And if you're expecting a 15% rate of return, I would start getting excited at around 1008 to 1009. And that's where I'll probably start entering my first position. So on top of that, I did a simple EV to EBITDA version, taking projections from the street to grow the top line revenue and also assuming that their cloud business matures over the next 5 years. So I took an EBITDA margin in the middle, which is around 32%, using a long-term EV EBITDA multiple of 16, whereas in the previous 5 years, it was somewhere between 15 to 25. So on top of that, assuming that they keep doing buybacks, the current price would return around a 12% CAGR, if the assumptions hold true, of course. So if I were to bump down the cost basis to $1,800 instead, my base case assumption would bring the returns up to 17% CAGR. Of course, I played around with the assumptions to work out both the bull and also the bear case for Alphabet. So I'll just attach it on the screen for your own reference and also scrutiny. So given the current $2,200 price tag, give or take, I don't see it as an incredible risk-reward opportunity. But of course, if it continues correcting downwards, I'll be more than happy to be an Alphabet shareholder. Bottom line is, by buying incredible companies like Apple, Google, etc., you'll probably not do too badly in the very, very long run, assuming that they continue their market dominance and superior business model, and there's no one that comes around to disrupt the entire industry. But on an individual basis, I'm sure many of you have your own quote-unquote rules that you abide by, and Google hasn't triggered my buy button yet. So I'm in no way saying that this is a bad investment, by the way, but who knows? Alphabet might bounce from here and I'll never have the fate to be a shareholder. Essentially, different strokes for different folks. Just a precautionary tale as well. If the bear market persists, valuations of wonderful businesses will continue taking a nosedive. And if Alibaba can go to $70, I don't see anything as really being impossible. So in today's market condition, I believe many investors are being extremely picky with a lot of their investment decisions. And don't be too sure of what will happen next. Because I would just like to repeat, nobody knows. So with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!